Solutions to National Bankruptcy, a comprehensive overview. Introduction. National bankruptcy is a critical issue that arises when a country is unable to meet its financial obligations, resulting in a default on debts. The implications of such a scenario can be severe, with consequences not only for the economy of the defaulting nation but also for its citizens and international financial systems. This report outlines various strategies and solutions that nations can employ to address bankruptcy, drawing on historical examples and best practices. Understanding national bankruptcy. National bankruptcy occurs when a government cannot repay its debt, which may be domestic or international. This situation can lead to a sovereign default where investors and creditors are unable to recover their funds. The consequences can include loss of access to international capital markets, economic recession, and social unrest. Key solutions to national bankruptcy. 1. Debt restructuring. Definition: debt restructuring involves negotiating with creditors to modify the terms of existing debt. This can include extending payment deadlines, reducing the principal amount owed, or converting debt into equity. Example: Greece's financial crisis in the 2010s led to significant debt restructuring efforts wherein the country negotiated with its creditors to reduce its debt burden and stabilize its economy. 2. Austerity measures. Definition: austerity measures are policies aimed at reducing government deficits through spending cuts, tax increases, and reforms. While they can help restore fiscal balance, they may also lead to public discontent and economic contraction. Example: countries like Spain and Portugal implemented austerity measures during the European debt crisis, which resulted in protests and significant social challenges. 3. Financial assistance from international institutions. Definition: nations facing bankruptcy can seek assistance from organizations like the International Monetary Fund (IMF), which provides loans and technical assistance. Such support usually comes with conditions including the implementation of economic reforms and austerity measures. Example: Argentina has repeatedly turned to the IMF for support in its economic crises, agreeing to various reform packages in exchange for financial assistance. 4. Monetary policy adjustments. Definition: central banks can implement monetary policy changes such as lowering interest rates or engaging in quantitative easing to stimulate economic activity and increase liquidity. Example: following the 2008 financial crisis, many central banks around the world adopted aggressive monetary policies to stabilize their economies. 5. Economic reforms. Definition: comprehensive economic reforms focusing on taxation, public sector efficiency, and regulatory frameworks can improve a nation's financial health and restore investor confidence. Example: countries like Rwanda have implemented significant reforms aimed at improving the business environment and attracting foreign investment, leading to economic growth. The bankruptcy process in context. Understanding the legal and procedural context of bankruptcy is essential. In the U.S., the Bankruptcy Code provides a structured framework for addressing not only individual and business bankruptcy but also municipal bankruptcy through Chapter 9. Key aspects include: petition filing. The bankruptcy process begins with the debtor filing a petition, which can be done by individuals, businesses, or municipalities. Chapters of bankruptcy. Chapter 7, liquidation, where a trustee sells non-exempt assets to pay creditors. Chapter 11, reorganization, allowing businesses to restructure debts while continuing operations. Chapter 9, specific to municipalities, allowing them to reorganize debts. Chapter 13, for individuals with regular income to propose a repayment plan. Common points and differences across sources. The importance of a legal framework in bankruptcy processes is emphasized across various sources, highlighting the role of federal laws and bankruptcy courts in the U.S. While some focus on consumer and business bankruptcies, others discuss broader implications for municipalities and international debtors. Timeline of key events. 1978. the U.S. Bankruptcy Code is enacted establishing a structured process for handling bankruptcies. 2005, amendments introduce stricter measures for consumer bankruptcies, including a means test for Chapter 7 eligibility. 2010s, European nations face financial distress leading to debt restructuring and austerity measures. Conclusion. Addressing national bankruptcy requires a multifaceted approach combining debt restructuring, fiscal austerity, financial assistance, and economic reforms. The legal framework established by bankruptcy laws plays a crucial role in guiding recovery processes. Each solution has its risks and benefits, and nations must carefully navigate these complexities to achieve long-term economic stability and restore investor confidence. In summary, while the path to recovery from national bankruptcy can be challenging, an informed and strategic approach can lead to sustainable economic health and growth. Counterintuitive information in solutions to national bankruptcy. 1. Austerity can worsen economic conditions. While austerity measures are often seen as necessary to restore fiscal balance, they can lead to economic contraction and increased public unrest. This counterintuitive outcome suggests that cutting spending and increasing taxes can have the opposite effect of what is intended, leading to deeper recessions rather than economic recovery. For example, during the European debt crisis, countries that implemented strict austerity measures saw their economies shrink further, contrary to the belief that such measures would stabilize their finances. 2. Debt restructuring isn't always beneficial. Debt restructuring, while often viewed as a positive step towards recovery, can have negative implications. For instance, if a country restructures its debts but fails to implement accompanying economic reforms, it may find itself in a similar situation of insolvency shortly thereafter. This paradox highlights that restructuring alone does not guarantee a country will avoid future financial crises. 3. International assistance may create dependency. Seeking financial assistance from institutions like the IMF can come with stringent conditions that, while aimed at stabilizing the economy, may lead to long-term dependency. This can be counterproductive, as countries may rely on external support rather than developing sustainable economic practices. Moreover, the conditions often imposed can exacerbate social tensions and lead to political instability. For monetary policy adjustments can have delayed effects. The belief that immediate monetary policy adjustments like lowering interest rates will quickly stimulate economic growth is often misleading. Such measures can take time to filter through the economy, and their effectiveness can be hampered by underlying structural issues. Furthermore, prolonged low interest rates can lead to asset bubbles, which may destabilize the economy in the long run. 5. Economic reforms may not yield immediate results. Structural reforms such as changes to taxation and public sector efficiency are often touted as solutions to restore financial health. However, these reforms can take years to implement and show results, leading to a scenario where immediate relief is not realized. This delay can lead to public disillusionment with reform efforts, causing social unrest and political backlash. 6. Bankruptcy laws are not universal solutions. The assumption that a robust legal framework for bankruptcy can effectively resolve national bankruptcy issues may not hold true across different countries. The effectiveness of bankruptcy laws varies significantly based on a nation's legal culture, political stability, and economic context. In some instances, these laws may be poorly enforced or may not address the specific needs of a country in distress, leading to ineffective resolutions. 7. The role of public perception. The perception of a country's financial situation can significantly impact its recovery efforts. For example, negative media coverage or public sentiment can lead to a lack of trust in governmental measures, causing citizens to withdraw their support for necessary reforms or economic measures. This counterintuitive aspect underscores the importance of managing public perception alongside implementing financial solutions. 8. Short-term gains versus long-term stability. Many solutions to national bankruptcy focus on achieving short-term fiscal stability, which can often come at the expense of long-term economic health. For example, severe cuts in public services might stabilize budgets in the short term but can lead to increased social inequality and unrest, undermining the very foundations of economic stability in the future. 9. The discharge mechanism isn't always favorable. The legal discharge of debts in bankruptcy proceedings is often seen as a fresh start for individuals and businesses. However, for nations, the idea of discharging debts can lead to loss of access to international credit markets, as lenders may perceive a country that has defaulted as a high-risk borrower. This counterintuitive result suggests that while discharging debts may seem beneficial, it can result in long-term financial isolation. 10. Asset liquidation may not solve underlying issues. The liquidation of assets in a bankruptcy scenario is generally intended to pay off debts. However, this process can strip a country of vital resources needed for recovery, such as public infrastructure and social services. The loss of these assets can hinder the country's ability to generate income in the future, creating a cycle of poverty and financial instability. In summary, while solutions to national bankruptcy often appear straightforward, the reality is that they can yield counterintuitive outcomes that complicate recovery efforts. Understanding these nuances is crucial for policymakers as they navigate the complex landscape of national financial distress. Important content often overlooked in national bankruptcy solutions. When discussing solutions to national bankruptcy, several key aspects tend to be overlooked yet are crucial for a comprehensive understanding of the situation and its potential resolutions. Below are critical points that deserve particular attention. 1. The role of trust in debt restructuring. While debt restructuring is frequently mentioned as a primary solution, the underlying importance of trust between a nation and its creditors is often neglected. Trust plays a pivotal role in negotiations, as creditors are more likely to agree to favorable terms if they believe that the nation is committed to implementing reforms and will ultimately honor any new agreements. The significance here lies in recognizing that financial obligations are not merely legal contracts but also social contracts that rely on mutual confidence. A lack of trust can lead to harsher terms and conditions, resulting in deeper economic distress. 2. Long-term economic reforms versus short-term solutions. Many discussions surrounding national bankruptcy focus primarily on immediate solutions such as austerity measures or seeking bailouts from international institutions like the IMF. However, the long-term economic reforms necessary for sustainable recovery are often glossed over. These reforms can include enhancing the efficiency of public services, improving tax systems, and fostering a more business-friendly environment. The significance of this is profound. Without deep-rooted reforms, countries may find themselves in a cycle of recurring financial crises as short-term fixes fail to address the systemic issues that led to bankruptcy in the first place. 3. Social implications of austerity measures. While austerity measures are often justified as a means to restore fiscal balance, the social implications of such measures are frequently underestimated. Cuts to public spending can lead to increased unemployment, reduced access to healthcare, and social unrest. The long-term consequences of austerity can erode public trust in government and lead to increased poverty and inequality. This is significant because it highlights the need for a balanced approach that considers both economic and social factors, ensuring that recovery efforts do not disproportionately burden vulnerable populations. 4. The psychological impact of bankruptcy. The psychological ramifications of national bankruptcy on citizens and stakeholders are often overlooked. The stigma associated with bankruptcy can lead to a loss of national pride and a sense of hopelessness among the population. This psychological burden may hinder economic recovery as consumer spending declines and investment wanes. Recognizing this aspect is crucial because it emphasizes the need for national narratives and communication strategies that promote resilience and hope during recovery efforts. 5. The importance of legal frameworks. While the report mentions the legal frameworks surrounding bankruptcy, the nuances of how these laws can be adapted or reformed to better serve national interests are often underexplored. For instance, The role of bankruptcy courts and judges in mediating disputes and ensuring fair treatment of creditors and debtors is critical. The ability to modify existing laws to better fit the specific economic context of a nation can significantly influence recovery outcomes. This is significant because it underscores the adaptability of legal systems in response to unique challenges posed by national bankruptcy. 6. Impact of globalization on national bankruptcy. Globalization has transformed financial systems, leading to interconnected economies. This interconnectedness means that a national bankruptcy can have far-reaching implications not just domestically but also internationally. The report may underplay the significance of how global financial markets react to a nation's bankruptcy, including potential investor flight, currency devaluation, and shifts in trade relationships. Understanding these dynamics is essential for crafting solutions that anticipate and mitigate negative global repercussions. 7. The gendered impact of economic policies. The gendered implications of economic policies implemented during and after national bankruptcy are often neglected. Women disproportionately suffer from austerity measures as they are more likely to rely on public services affected by spending cuts. Additionally, job losses in sectors that predominantly employ women can exacerbate existing inequalities. Highlighting this issue is significant because it calls for policies that are equitable and inclusive, ensuring that recovery efforts do not reinforce existing disparities. 8. The role of civil society in recovery efforts. Civil society organizations often play a crucial role in advocating for equitable solutions during national bankruptcy. Their involvement can help ensure that the voices of marginalized communities are heard in the decision-making process. However, the report may not adequately emphasize the importance of engaging civil society in recovery efforts. This is significant because it fosters a more democratic approach to governance, ensuring that recovery plans reflect the needs and aspirations of the entire population. Conclusion. In summary, while the report provides a broad overview of solutions to national bankruptcy, it is essential to delve deeper into the nuances surrounding these solutions. By focusing on trust, long-term reforms, social implications, psychological impacts, legal frameworks, globalization, gendered effects, and the role of civil society, stakeholders can develop more robust strategies to navigate and recover from financial crises. These often overlooked aspects are significant not only for achieving economic stabilization but also for fostering social cohesion and resilience in the face of adversity. Key points for in-depth analysis and discussion on solutions to national bankruptcy. 1. Debt restructuring. Overview. Debt restructuring is a critical solution for countries facing bankruptcy. It involves renegotiating the terms of existing debt with creditors to make it more manageable. Techniques include extending the payment period, reducing the principal amount, or converting debt into equity. Case study: Greece serves as a prominent example where extensive debt restructuring was necessary to stabilize its economy following the Eurozone crisis. The negotiations led to significant write-downs of debt and introduced measures aimed at restoring fiscal balance. Analysis: This approach raises questions about the long-term sustainability of such measures and their impact on international relations. It can lead to a temporary respite but might not address underlying economic issues. The implications for investor confidence and future borrowing capabilities are also critical to consider. 2. Austerity measures. Overview. Austerity measures, which typically involve cutting public spending and increasing taxes, are often implemented to regain fiscal stability. These measures aim to reduce budget deficits and restore investor confidence. Consequences: While austerity can stabilize financial conditions in the short term, it often leads to public unrest, economic contraction, and increased unemployment. Countries like Spain and Portugal experienced significant social unrest during their austerity periods post-2008 financial crisis. Analysis: The effectiveness of austerity measures can be hotly debated. While proponents argue they are necessary for fiscal discipline, Critics assert that they exacerbate economic downturns and social inequality. The balance between fiscal responsibility and social welfare is a crucial discussion point. 3. Financial assistance from international institutions. Overview: countries in financial distress often turn to international financial institutions like the International Monetary Fund (IMF) for assistance. This support usually comes with conditions that mandate economic reforms and sometimes austerity measures. Impact on sovereignty: the conditions attached to such financial assistance can lead to debates about national sovereignty and the role of international institutions in domestic affairs. Countries may feel pressured to adopt policies that may not align with their economic or social goals. Analysis: the strategic implications of relying on international assistance can be profound. It raises questions about the dependency of nations on external entities for financial stability and the potential for such relationships to influence domestic policymaking and governance. 4. Economic reforms and structural adjustments. Overview: beyond immediate measures like austerity and restructuring, long-term solutions often require comprehensive economic reforms. These can include changes to taxation policies, public sector efficiency, and regulatory frameworks to enhance competitiveness and restore investor confidence. Sustainable growth: structural reforms focus on creating a more resilient economy capable of withstanding financial shocks. They aim to diversify the economy, reduce dependence on external debts, and improve public services. Analysis: the path to implementing effective reforms can be fraught with challenges including political opposition and social resistance. The discussion should focus on how to achieve buy-in from various stakeholders and the role of governance in facilitating successful reform. Conclusion: the solutions to national bankruptcy encompass a range of strategies, each with distinct implications for economic recovery and social stability. The interplay between debt restructuring, austerity measures, international assistance, and structural reforms presents a complex landscape that requires careful navigation. In-depth analysis of these points can highlight not only the economic but also the social and political ramifications of each approach, offering a multifaceted understanding of national bankruptcy solutions. Here are 3 famous historical cases that illustrate solutions to national bankruptcy. 1. Argentina 2001–2002. In late 2001, Argentina faced one of the most significant economic crises in its history, culminating in a national bankruptcy. The government defaulted on approximately $100 billion in debt, making it one of the largest sovereign defaults ever. To address this crisis, Argentina implemented several strategies. Debt restructuring: the government negotiated with creditors and in 2005 reached an agreement to restructure about $62 billion of its debt. This included offering new bonds with lower values and extended maturities, effectively reducing the debt burden. Austerity measures: following the default, Argentina implemented harsh austerity measures aimed at stabilizing the economy. This included cuts to public spending and social programs, which were met with significant public unrest and protests. Economic policy reforms: to regain economic stability, Argentina adopted a policy of currency devaluation, moving from a fixed exchange rate to a floating one, which helped boost exports and tourism. These measures eventually led to a period of economic recovery. 2. Greece 2010–2018. Greece's sovereign debt crisis began in 2010 when the country revealed that it had been understating its budget deficit for years. This led to a loss of investor confidence and an inability to finance its debt. The solutions involved international financial assistance. Greece received multiple bailout packages from the European Union (EU) and the International Monetary Fund (IMF), amounting to over €260 billion. These funds were conditional on the implementation of strict economic reforms. Debt restructuring: in 2012, Greece underwent a significant debt restructuring which included a write-down of approximately €100 billion of its debt. This was the largest sovereign debt restructuring in history and aimed to make Greece's debt sustainable. Austerity measures. The Greek government had to implement severe austerity measures, cutting pensions and public sector wages as well as increasing taxes. These measures caused widespread protests and social unrest, highlighting the societal impact of such policies. 3. Iceland 2008 to 2011. Iceland's financial crisis began in 2008 when its banking system collapsed under the weight of excessive debt and risky investments. The country faced national bankruptcy as it could not bail out its banks. The solutions included banking sector restructuring. Iceland allowed its major banks to fail, taking a hands-off approach rather than bailing them out. The government then nationalized the banks and restructured their debts, creating new banks with healthier balance sheets. IMF assistance. Iceland sought assistance from the International Monetary Fund, which provided a loan package of about $2.1 billion. The IMF's conditions included implementing economic reforms focused on fiscal consolidation and restoring financial stability. Capital controls. To stabilize the economy, Iceland implemented capital controls to restrict the movement of capital out of the country. These controls were aimed at preventing further economic instability and were gradually lifted over time as the situation improved. These cases illustrate the complexities and varied approaches nations can take when facing bankruptcy, highlighting the balance between fiscal responsibility, social stability, and economic recovery. Future outlook. Predictions for solutions to national bankruptcy. As we look ahead to 2025 and beyond, the landscape of national bankruptcy solutions is expected to evolve, influenced by global economic trends, technological advancements, and shifting political dynamics. Below are key predictions regarding how nations may address the challenges of bankruptcy in the future. 1. Increased emphasis on debt restructuring. Countries facing bankruptcy will likely prioritize innovative debt restructuring approaches. As seen in past crises such as Greece's financial turmoil, restructuring will involve not just extending payment terms or reducing principal amounts, but also incorporating more creative solutions like debt for equity swaps. This trend may be facilitated by the growing acceptance of participatory finance mechanisms where creditors and nations collaborate on sustainable repayment plans that consider economic recovery and growth potential. 2. Austerity measures revisited. While austerity measures have often been criticized for exacerbating economic hardship, governments may adopt a more nuanced approach moving forward. Future austerity measures might be accompanied by targeted social programs designed to mitigate negative impacts on vulnerable populations. Furthermore, countries may implement gradual austerity measures in tandem with structural reforms, allowing for a more balanced approach to fiscal discipline. 3. Enhanced role of international financial institutions. The International Monetary Fund (IMF) and World Bank are likely to play an even more critical role in assisting countries in financial distress. As global interconnectedness increases, these institutions may develop more flexible lending frameworks that allow for rapid response to emerging crises. Additionally, countries may benefit from tailored assistance programs that combine financial aid with technical support in implementing economic reforms. 4. Adoption of digital currencies and blockchain technology. The rise of digital currencies and blockchain technology will reshape how nations manage their monetary policies and financial transactions. Central bank digital currencies (CBDCs) could facilitate quicker, more efficient fund transfers, and smarter contracts could automate aspects of debt management, making the process more transparent and less prone to corruption. These technologies may also provide new avenues for countries to manage their debts and attract foreign investment. 5. Focus on sustainable economic reforms. Future solutions to national bankruptcy will increasingly emphasize sustainability. Governments may pursue economic reforms that align with environmental, social, and governance (ESG) criteria. This could involve redirecting investments toward green infrastructure and renewable energy projects, which not only stimulate economic growth but also enhance a nation's resilience against future financial crises. 6. Public-private partnerships (PPPs). As nations seek innovative financing solutions, the role of public-private partnerships will likely expand. These partnerships can be instrumental in funding critical infrastructure projects, which can stimulate job creation and economic growth by leveraging private sector efficiency and investment. Governments may alleviate some financial burdens while enhancing service delivery. 7. Use of predictive analytics for fiscal management. The integration of advanced data analytics and artificial intelligence in fiscal management will become more prevalent. Governments may utilize predictive analytics to forecast economic trends, manage budgets more effectively, and identify potential financial risks before they escalate. This proactive approach could lead to more informed decision-making and better financial health for nations. 8. Rise of alternative financing models. In response to traditional banking system limitations, countries may explore alternative financing models such as crowdfunding and peer-to-peer lending. These methods can provide much-needed capital for small and medium enterprises (SMEs), helping to stimulate economic growth and create jobs, which are crucial for recovering from financial distress. 9. Re-evaluation of bankruptcy laws. As the nature of national bankruptcy evolves, countries may embark on comprehensive reviews of their bankruptcy laws. This could lead to the adoption of more flexible and inclusive legal frameworks that better address the unique circumstances of modern economies. For instance, nations may consider introducing provisions specifically designed for municipalities or regions facing fiscal challenges. 10. Global collaboration on economic stability. Finally, the future will likely see enhanced global cooperation in managing economic crises. In an increasingly interconnected world, national bankruptcies can have ripple effects that extend beyond borders. Countries may engage in multilateral agreements to promote fiscal responsibility and share best practices in debt management and economic recovery strategies. Conclusion. The future of solutions to national bankruptcy will be shaped by a combination of innovative strategies, technological advancements, and collaborative efforts on both national and international levels. As countries navigate the complexities of financial distress, the emphasis will likely shift towards sustainable, inclusive, and resilient economic policies aimed at preventing future crises and ensuring long-term stability.